decisions, by the way.
100%. She makes better investment decisions than me. There is no question about that.
Oh, okay, then does she buy SoFi?
She is a SoFi shareholder, yes.
Oh, there we go. Then we're guaranteed to succeed.
But she didn't come up, in all fairness, she didn't come up with that one. But like everything she touches turns to gold. Like she bought Ford at $1.80 during the freaking financial crisis when everybody was scared of it. So she does very well.
It's awesome. That's awesome. Ladies and gentlemen, welcome to
Instacart Weekly, baby.
You got so much hate for that one, hey?
You know, the irony, bro, is I looked at the numbers and I think everyone saw the stat. They made $711 million off just advertising.
Yeah, it looked pretty good from what I saw.
Which means they're a tech company more than they are just a grocery platform. Like when you make 700 million, that's almost $1 billion off ads. That's 1/4 of Twitter's revenue.
What part is not a technology company?
I mean, people were saying that it's a grocery platform. Right? So yes, it's a tech company in the same way that Netflix is a tech company, but it's just a media company. But when you're cultivating people's attention to the point where you can charge on advertising, I think that like it solidifies you more into the tech range. Obviously, they're a tech company, but
yeah, when he says people were saying they're a grocery company, it was only Mitt.
No. There's a lot of bearish articles. You haven't read enough about Instacart, bro. All
right. Let's talk about
that was the minute and 30 Instacart segment.
Yeah. No. This is the weekly. We're doing the whole pod on Instacart. I don't know what you guys are talking about.
Tevis, take it away.
Yeah. So a bunch of SoFi news over the past week. I think we actually want to do some topics for this one. The main thing that I don't know if you guys have seen it or haven't seen it. Chris posted his article yesterday on student loans and how that was going to be driving some pretty positive results in 2024. Wondering if you guys have read it or not yet.
I've read parts of it because I was going to have a conversation with Steve, but I haven't given it a thorough look.
Steve, have you read it?
I read it, yes.
I have read it as well. I interviewed Steve about it live as well. There's a lot to that article. So where do we want to start from?
Oh gosh, all the comments are about Riley. We were just talking about this. Sorry.
Riley is taking a break for a while from SoFi Weekly. It's just, guys, content creation is a lot. You know, some people just don't feel like doing it every single week. So I think eventually he'll be back, but for now he's chilling, sitting on his SoFi gains.
Yeah, he's welcome to come back whenever.
Yeah. Okay, so I also, similar to Tanner, I've read parts of this. I haven't read the full thing, so maybe Amit or Steve, you guys can lead on this topic.
Okay, so I'll start off. I think this first part is really important. And shout out to Chris, Data Driven Investing. You guys should definitely follow him on Substack. So this is the first thing. So the cost of
the first thing, you're halfway through the article.
well, this is like the first part of it, I guess. This is the most important part. The what has happened over the past 3 years is the weighted average interest rate, the return they're getting from the student loans, and then the cost of capital of those student loans. As you can see, they've kind of become very slim. And as a result of that, SoFi has not been able to make a strong NIM or net interest margin or spread on student loans. That is changing, is what Chris is saying, as we get more originations. And as a result of that changing, he says by 2024, full year, SoFi should be able to originate about $1.6 billion in student loans. Now, what was really interesting to me is he came on my pod yesterday and he said that we are not going after bachelor's degrees. We're going after master's degrees, these like lawyers, doctors, these type of people. And I didn't know that. I actually was confused on that subject. We're going after people who are in more elite arenas, which means they're likely to be less delinquent on it. And as a result of that, there's $1.6 trillion in student loan debt. Chris Hager's point was we just have to get 0.01% of that market. So out of that $200 billion TAM, we just need 0.01% of that for that to have a meaningful impact on SoFi's EBITDA by full year 2024. And as a result of that, investors should do pretty well if that happens.
Yeah. So why are we talking about this right now? Well, basically, decision has been made. Student loans is coming back. The interest is starting as of September 1st today, and payments are going to be starting as of October. So in the fourth quarter, when SoFi reports numbers in January for the end of 2023, student loans is going to have a part to play. The 1.6 billion was the bullish scenario. And I think it goes from 1 to 1.3 to 1.6. That was the range that Chris had in terms of bearish, baseline, and bullish. Point being that it's still fairly good, right? Because this is Q4 of 2023, and we expect an acceleration in that ramp as student loans goes back to full force. Back in before it was canceled or postponed in 2020, they were doing over 2 billion in originations,
which is insane. Like 2 billion is crazy, and that all went to shit during the pandemic.
And then just to think about it, like back whenever all this came crashing down, we were doing around about 400 to 600 million dollars in personal loan originations. Now we're doing 3.7 billion. So everywhere where student loans lost, personal loans picked up, and yet now they're both going to be going after each other. Now, Lending Club, I'm curious what you guys think. Lending Club thinks that there might be a potential where student loans is actually cannibalistic to the personal loan market, that if people are getting, having to pay their student loans back and these sorts of things, that they're not going to be as quick to pile on more debt because now they can't afford it.
So what was your question?
Do you think that going to cannibalize personal?
Yeah. Do you think that student loans will actually have a large seeable impact on the actual macro environment, that there won't be good enough spending because people are going to have bills that they didn't previously?
Steve, what do you think?
It's a difficult question. We really need a couple months worth of data once they come back to see, because you can make a case either way for it. But I think the way that you need to look at that is human nature responsible? Most people are not responsible. So, I mean, I can see it where people may have thought that student loans weren't coming back. They may have thought it was actually going to get forgiven. They may not have planned for the future. And now they're going to have to rebudget with payments starting back up. That could impact short-term spending because they have to reallocate money toward the repayments that they weren't having to pay out previously. Is it going to hurt personal loans? Is a much different question, because people take out personal loans for a lot of different things. You're not taking out a personal loan to go buy a computer. You're taking a personal loan to do work on a house, for a car. If you don't want to get a car loan, if you can get a better rate on a personal loan, you're taking out personal loans for much different things. So I don't know that you're really going to see that get hurt, because if you are doing work on your house or you want to do something like that, I don't know that student loans restarting is going to necessarily put that to the side, only because most student loan payments are how much? $500-600 a month?
Not for masters.
Yeah.
How much is that? I really don't know. I've never looked at what the average student loan payment is.
I think for the customers that SoFi is trying to go after, I think the 70,000 student loans was their average or something along these lines, and that was about a $700+ bill. If they amortize it across like 20 years, it would be something like $550.
Yeah, I mean, look, that's a significant bill for a lot of people. The majority of the population, that's a significant bill. I think you're going to see people possibly spend less on credit cards and spend less on consumer goods. I don't know that they're going to spend less on large projects or large expenses that they would need a personal loan from. I think people take personal loans for much different things and they use a credit card for it. So I think we need a couple months to see how that plays out.
So I wanted to answer two things. There's a question in the chat that I wanted to answer, and then also the Chris Hager's article, so that the actual net interest margin really collapsing on student loans is true, but I don't think that chart is accurate enough to really see how much it's actually closed out. Because the problem is that what that chart is not telling you is that that's all the student loans for SoFi held totally, right? So there are loans, like for example, I think we're holding $5.4 billion worth of loans right now, which are, some of them have much longer maturities at much, much lower interest rates. We're only signing on about 400 million new student loans right now. So the rate at which these new loans are increasing the interest for the weighted average is not fast enough. The actual new loans that we're signing on right now are probably along the lines of about 8-9%. So like, I don't think that it's a fair comparison comparing our overall portfolio with the growing current state of cost of capital, if that makes sense.
Do you think that discredits the argument he's making, or it's kind of just not as specific, is what you're saying?
Well, I mean, it's true. Like, I mean, it's not true, but I do think that the net interest margin of the new loans that we're signing are a much larger margin than what that chart tells you, like for sure. Because we're not signing at 4.9%. We're signing at much higher rates.
They're taking a federalized loan and then they are recapitalizing it with private money that they're borrowing at a lower rate than they previously were, because when the bulk of the student loan were going, they did not have a bank charter. So they were borrowing at a higher rate. I mean,
well, we're borrowing higher now with a bank charter because the interest rates are much higher.
On interest rates and what we're paying out in interest for the borrowing off the balance sheet, yes, but we need to see a couple of months worth of data. It's not really worth speculating on this because we have no idea what's going to be right and what isn't going to be right. Chris's numbers look good, but I mean, we need a couple of quarters.
Yeah. No, I'm really, really excited for the student loan, moratorium to end. I haven't looked into how much Biden's new plans like the SAVE plan and stuff like this are actually going to impact that or slow down the new amount of people that are re-signing up for personal loans. But just in the way, like even high affluent people, we have to remember the people that weren't even going to get this relief were people above $125,000 worth of income. That's still way above the threshold of people that, SoFi even deals with, about $170,000 for student loans. So this is going to be popping off. The student loans, home loans are going to be popping off during that same time. Hopefully personal loans are not being cannibalized by these new products, all while SoFi brings on more SoFi Invest members than, other competitors like Robinhood. So SoFi money is still popping off and everything is going so well. I honestly think 2024 will be, what do you call it? Like catalyst moment for SoFi, where we really see multiples really multiply.
And Tanner, think about it like this. You've had personal loans carry originations for, I could bring up the chart. I'm not in my Google sheet, but it's carried originations.
Roughly 3 years now.
Yeah. So seeing personal loans decline a little bit, as long as student loans and mortgages go up and originations grow overall, I'm not concerned at all. And I do think 2024 will be a good year for originations. And we could see a correlation, which I'm very interested in. Look, this is more of a 2025 thing, what I'm about to say, but I want to see if there's a correlation between mortgages going up and personal loans going up, because you could have people buying houses and then deciding to do remodeling or deciding to do other capital projects on the house.
Definitely.
And maybe they're not tapping a home equity line of credit. Maybe they are not taking out additional capital on a mortgage, and maybe they're going to tap a personal loan instead. So it's going to be interesting to see how that plays out.
Do you know the two most common reasons why people took out a SoFi personal loan?
I do not, but I'll guess.
Yep.
And you can tell me if you're right. One of them I would have to think is home improvement.
A very specific home improvement.
Remodeling a kitchen.
Solar installation.
Okay.
Wow.
Would not have guessed that. But
So number one, debt consolidation. And then a large part of their growth during 2020 and 2021 was solar installs. In fact, it was so large, they talked about it in an earnings call.
I love that, though. I mean, it speaks to the type of cohort that SoFi is going after. Like, if debt consolidation is the first one, they're financially savvy, like that tells you a lot. And then the solar, aspect, that's not like, I don't know. I think of all the types of remodels that it could be, or the home improvements it could be, I think just having the solar aspect as well is it's exactly what I would imagine, and it just makes me more comfortable. I want to come back to just your earlier point around student loans eating into personal loans and just present a little bit of the counterpoint. I think that yes, to some degree, I'm sure there's going to be a subsection of people who, who that might be affected by that. But I mean, we've been through a time where inflation has been rising, and then credit card debt is like all-time highs. The fact of the matter is that like they're restarting. There's going to be originations that are not zero, right? There's going to be a growth in those originations. And this was SoFi's main business up until 2020, right? And so regardless of how fast or how slow that ramp is, I mean, even Chris had like a 600 million variance in just what that number is going to be for Q4. It's going to be starting up regardless of what the macro is at that particular moment, which is a net positive for SoFi, and it's going to be positively affecting their numbers. Now, I think that's the wider point to be taken away is this is coming back, and regardless of the strength and the velocity at which it comes back, it's here to stay essentially from now onwards. So, yeah.
All well, hopefully deposits still come on and lower cost of funding and new originations still continue to pile on. I think one of the best things that Chris said in any of his recent articles was that SoFi's moat is them differentiating themselves while being in the same market as their competitors, right? He talked about deposits whenever looking at, I forget all the names that he was choosing. I think it was Ally, Lending Club, Upstart, or not Upstart, sorry. That was for origination. Sorry, that was a different article. But there was a bunch of names that he was talking about with deposits. Now, all of them had saw peaks in deposit growths in Q4 of 2022, and then actually started to decline after that, where SoFi did not see that. They continued to grow quarter over quarter and is still seeing new highs. And it's very different versus the competitors. And why is that? Because like Chris Hager even showed off, it doesn't have to do with APY. Whenever looking at Lending Club, they held higher APYs than SoFi. There was a bunch of other competitors that hold higher APYs, and that's still not the differentiated factor. One thing that people get so caught up about with the APY thing is look at Cash App. Cash App's the greatest example of why this doesn't matter, okay? They just came up with a product called Cash App Savings, which was their fastest ever growing product that they've ever released. What's the APY, Tevis?
Zero.
Good guess. or if you knew it, I don't know.
Cash App doesn't offer an APY, man.
Yeah, and it doesn't matter because, in fact, I do think that was very deliberate to not even have people shop or try to compete with their things. If you want to keep money in a separate money box on Cash App, there's an option to do so, and we're not going to offer you anything past that. And it was fine.
Will you bring up B-Dubs' comment from 1014 a minute? I'll read it out to you, Tanner. I want you to answer this, maybe just as a refresher. So what's the main selling point on SoFi? So what's the rate on federal student loans? They're lower than what SoFi can offer. So the only selling point to refinancing is extending the payoff period from 10 to 20 years. So new originations are lower than what SoFi can offer. Okay, but that doesn't mean that existing ones aren't. So that's what the $200 billion total addressable market is. There's $1.7 trillion worth of federal student loans out there right now. 200 billion is in that certain amount of interest rate that SoFi actually thinks that they can go after. That's excluding all the FICO and credit scores. So there still is a massive amount that people could actually refinance that would actually be cheaper to go with SoFi. And then there's what he said there between extending the payoff period from 10 years to 20.
See, what they've already noticed is that there's some people that would rather take, let's say instead of 7% that they could get with the government, they would take 8% if they could extend it over 20 years instead, because then that means that the monthly payment would go down. You could take something that would be, 700 and like I was talking about before, $700 plus, I think it's like 730, 740, and then lower it to 550 per month, but yet you're extending it over an extra 10 years. Whether that's a smart financial decision for an individual, that's up to them, but it is an option, and that could lead to a ton of originations for SoFi.
I do think not to get on a super big tangent here, but I do want to say I think the real guy that's going to help us make a lot of money on SoFi is Donald Trump. Okay. Because if he didn't pick the Supreme Court justices he picked, Biden's plan would have passed. And, well, to counter my own point, I don't know if Biden's plan would have affected SoFi student loan business that much, but definitely we would have been in an environment where student loans would have been more easily forgiven, at least that 20 grand Biden wanted to do. Again, I don't know how much that affects SoFi, but the fact that we had those 4 years and we had those conservative justices, that's a big reason for why we're in the situation that we are in today.
Can I give you a counterpoint?
Go ahead.
It was Donald Trump's idea to put the student loan moratorium in place in the first place. So I think maybe he had the largest
good point.
negative effect on SoFi than any other person, maybe.
That's a great point. Yeah.
Didn't Biden run on canceling student loans altogether?
Yes. Yes. I'm sure he got at least a couple million votes off that $10,000.
I think he wanted to do more than 10,000. He limited. I forget what it was, but yeah. It definitely, student loans has been a contentious point for practically both parties. But yeah,
I have exactly 10,250 in loans, and so if Biden canceled it, I would have nothing. So I'm getting ready to pay it off in the next couple months. But I mean, yeah, I haven't had to pay it for 3 years, and this whole idea people are saying about there's so many articles I read that people are just not going to pay them. Again, that doesn't affect SoFi because that's not our market. Our market is not the kids who got liberal arts degrees that feel that they hate the world and they don't want to pay back their loans. It's people that are in very, very well positions in life. They just want to be able to pay a little bit less, and so they're going to refinance, and that's where SoFi comes in.
Can we pivot to a couple of other pieces of news this week? So something else, I made a video about this on Monday. Galileo updated their developer documentation to account for SMB lending. I'm going to send you the link on our private chat, and you can throw this up. So this is definitely good. Well, it's interesting, and I want to chat about it. So basically what this allows Galileo to do is, as part of buy now, pay later, this is B2B, for them to offer to small and medium-sized businesses the ability to create lending products. Now, obviously, those businesses need to have a partnership. They either need to have a banking license or a partnership with a bank, essentially somebody who has a banking license. Some of the use cases that SoFi highlighted here in their documentation is startup capital, working capital, and the other one was, I think, Amit, if you scroll down, it was operating capital, expansion capital, and working. And if you look at some of the benefits down below, SoFi highlighted a couple of benefits. Amit, if you'll stop texting and just scroll a little bit more. Dude,
my girlfriend, bro, she's crazy.
Yeah, my girlfriend. Yeah.
So I don't know why you guys are laughing, but okay.
Yeah, my body pillow in the other room is vibrating. Sorry, trying to turn it off.
Anyways, what do you guys? Let's open the floor for SMB lending on the Galileo front. I think this is interesting. Somebody brought up in the comments of that video that I made to say that, well, SoFi is definitely going to be the partner bank, right, for people who want to be doing this. And I'm not sure how exactly this is going to work. How I was imagining it is, let's say, Shopify wanted to provide loans to some of their merchants on their platform. Shopify doesn't have the infrastructure to do that, so they would do it through Galileo with a partner bank. That's at least how I was picturing it. Whereas where Galileo is essentially the provider of, through their APIs, they're providing SMB lending. They're providing the recipient business the ability to lend to other merchants. I can see you guys.
But I'm confused. Are they providing capital for SMBs?
No.
So
they're
this
just
is
providing their APIs, they're providing the infrastructure, and that SMB would be now giving. So if you go down a minute to what the API provides, so basically this is what they can do. They can simulate a loan so that they can compare different APRs, different loan terms. They can customize the loan however they want to. They can then see the status of their loan. They can see the burn down of their loan, the payment schedule. They can charge off accounts. They can disperse funds. Now, the interesting part is the synergy here with Galileo and SoFi, because SoFi has a banking license. They have the bank charter. And so let's say I'm Shopify. I don't already have a relationship with a bank. This can come as a bundle where Galileo can be offering me the infrastructure. SoFi is the partner bank getting a percentage off that. And all of a sudden, I, as a tech company or as Shopify, can start providing this through that Wombo combo of Galileo and SoFi together.
Did you say Wombo?
Wombo combo?
Wombo, hyphenated.
What's Wombo?
It's an old Smash Brothers Melee meme that he's talking about.
Oh, you just reminded me of SpongeBob. Do you remember that episode?
Stay on point.
You remember that episode though, right? The Wombo?
Okay, dude.
You remember, Tanner, you remember it or no?
No, I would never watch it.
Okay, I'm gonna get this clip, but okay, go ahead, Tanner. I mean, Tevis.
No, that's it. Like, I just wanted to know what you guys thought, because this was pretty big for me. Because if you're looking at it through a one-dimensional lens, you're thinking about the benefits to Galileo. But then if you look at it through this multi-dimensional lens, with SoFi being the partner bank, then it's mutually beneficial to both companies, because they can essentially bundle that offering to have like this full suite of white glove service to whatever recipient bank. As you guys answer, I'm going to start reading the chat because you guys are laughing. So keep that in mind.
Everyone in the chat recognize it's 46 seconds. Let me play it. It's 46 seconds.
Dude, do not do
It's 46 seconds. That's it. Then we'll get back. We'll get back.
SpongeBob. I am also.
Man.
You're just demonetizing all of us.
Why do I even try anymore?
Oh wait,
do not play SpongeBob right now.
It's not Nickelodeon. It's
just
fucking. I promise it's not going to. It's 46 seconds. They're not going to demonetize. I promise.
Absolutely will, bro.
That was literally the most epic thing ever. What the heck is this?
This is entertainment.
This is cool. The goats. Everyone remembers Wombo. Okay, no. In terms of the SMB thing, I think it makes a lot of sense. It's interesting they're doing it because SoFi's bread and butter.
Thing?
What?
SMB. Yeah. Okay. Yeah.
SMB,
the SMB.
yeah. The small business loan. SoFi's business is giving loans, right? Galileo is their tech play. So if their tech play is coming up with a lending API, essentially product for small businesses that is within the wheelhouse of what the parent company is making all the money off of, I think that's really cool. That makes a lot of sense. How successful will it be? I don't know, but it definitely seems like there's a massive market for small businesses that need some type of.
So commercial lending for SoFi is a tiny bit. Like, so Galileo's had lending APIs for a while. This is just very specifically for small to mid-sized businesses.
Right.
I'm still excited about it. This could open up possibilities for partnerships with companies similarly to Shopify or Square Seller rather than just Cash App. Like, there is a lot of opportunity here. But it's not like this is the Galileo's first trip in lending.
Okay.
But still exciting. I mean, all the new products are quite exciting. I did actually leak this on my Fintech frenzy, obviously the first place to get news. But I will say it to a larger audience here during the SoFi Weekly. My connections did leak that SoFi just got in a bed with Experian. Launched a new beta for a product called Experian Smart Money. I've been trying to locate it. I literally can't find it. I'm going to need some people that are more willing to deep dive and try to find this, like similarly the way that Riley found all that stuff. So if Riley's listening as well, please find that. But Experian Smart Money, they're launching. They sent out emails to over 1 million people. And it's going to be one of the large financial institutions that Galileo just launched with. And that was just the other day, 2 days ago.
Yeah, we're definitely going to see a resurgence in the tech platform as we go into I mean, look, management has given us that blueprint. They said, hey, margins are going to be hit. Growth is going to be hit. We're moving from on-prem to cloud. We're making these cuts on the Galileo side. We're focusing on, we're focusing on this roadmap. and everything is going to come back towards the end of the year, right? So we expect that a resurgence in growth in terms of technology accounts towards the end of the year. We expect a resurgence in the margins that we've come to expect from Galileo and Technisys as a consolidated business now. And it seems as though from everything that we've been seeing in terms of little product drops or partnerships or whatever, they're executing on that. There's no reason for us to be doubting that they're going to be missing any of their expected numbers.
This is, I think, the most legit question I've ever seen in my life.
Absolutely not. I would not let Tevis steal all of my video ideas before posting them myself.
You just throw shade at the one special guest you have on your podcast every day?
Bro, that's not true. I just have my second special guest of all time. Chris Hager was on.
Dude, put it in the chat if every time Tanner says special guest, you guys click because you're excited, and then it's Tevis. And nothing against
you get baited. It's
Tevis. It's Tevis.
Yeah.
Dude,
I threw a little
Bender is
extra.
definitely Anthony Noto.
Me?
Maybe, bro.
Bender is definitely Anthony Noto.
You said he's not an insider. I don't believe it. I just think he's a tech nerd. I know maybe you were joking, but still. So Amit, I threw a little shade out there on a company that you like today. I wanted your opinions in person.
Well, speaking of that company, we have someone on this live stream, okay, that I had a phone call with last Saturday. I didn't have a phone call with Tevis. Didn't have a phone call with Tanner. So there's only one person.
What are we talking about?
There's only one person. Steve, I'm bringing you into the conversation here. Let me do it. Okay?
Jesus.
Phone call with yourself, or
I have some money in a company that Tanner keeps shitting on and ruining my investment because he's influencing the masses to sell the stock. So I reached out to my guy, Dividend Streams. I'm like, yo, look at Robinhood. Maybe there's something here. And Steve, we talked last week. I gave you my due diligence. How come there's no article yet on Seeking Alpha for Robinhood? Telling people to buy Robinhood because I need
bring the value investor into this. Let's hear
so that I can make money. Why haven't you done it?
Well, first, as I told you on the freaking phone, I don't write articles for any other reason than they're my opinions, and I haven't finalized my opinion on Robinhood yet.
Okay, so let's hear your opinion. They're gap profitable. Tanner thinks the company's full of shit. They bought back 55 million shares today. Okay,
Yes,
they took 7% of the float off for shareholders.
Yeah,
Stock was only up 1%,
and the
which
stock
is
went
great.
up 2%.
Which is great to me because that means the market still doesn't get it, and that's like
before we get into this, because we could spend 10 or 15 minutes on this. Can we at least talk about the enhanced yield ETF and the Goldman Sachs conference for next week, and then we can talk about Robinhood?
Yeah, so
take it away.
Goldman Sachs conference is going to be on Wednesday, September the 6th at 4 p.m. Eastern or 1 p.m. Pacific time. Anthony Noto is going to be speaking at that conference in a fireside. These conferences in the past have been golden opportunities for us to get nuggets of information and just overall strategy about how management is thinking about things. And then, Stephen, you're going to kick us off on this one. The next piece of news, SoFi to launch a new enhanced yield ETF with option strategies as well. So this was also by Bender 9000, and I haven't made a video about this one yet. Amit, if you can throw it up on screen, then Stephen can walk us through this one a little bit.
Yeah, so the Goldman Sachs conference is going to be huge. I think this is going to be very big only because you have student loans coming back, and I think that we're going to see some really good insights. I'm very excited for this, and I'll probably do an article on the conference next week going into SoFi Weekly. And then you guys sent this to me maybe 20, 30 minutes ago, and I actually skimmed through the SEC filing. And it's interesting because it says in the principal investment strategies that the fund seeks to achieve its objective by combining a strategy of holding U.S. government securities, including U.S. T-bills and Treasury bonds, with a credit spread option strategy. So 2 to 5% they're going to hold in cash and cash equivalents, 95 to 100% in Treasury securities, and then up to 90% credit spreads using the fund's holdings of Treasury securities as collateral for the fund's investments in options. So the options that they're looking at doing specifically says the fund will invest in a portfolio of U.S. Treasury bills and/or U.S. Treasury bonds with a targeted portfolio duration of approximately 1 year, and they will generate annual interest income and capital gains. At the same time, the fund will purchase, buys, and write, sells, put or call options on the following three major equity indexes: the S&P 500, NASDAQ 100, and Russell 2000. Strategy is referred to as a credit spread or vertical credit spread strategy and acts as an overlay on the fund's portfolio. Further, throughout the filing, it says that it's going to be monthly dividends paid out. I didn't get into all the tax stuff, nor would I talk about it. People should read that and talk to a CPA. I don't talk about tax stuff. But for those that are not familiar with a credit spread option strategy is a derivative that involves buying and selling options on the same underlying asset. So it's very interesting because you see how big JEPI is and JEPQ is from JP Morgan. I don't have it up. I think JEPI has like a 26 billion NAV, and let's just bring it up so I don't give out bad numbers. So JEPI has 29.37 billion in assets under management. JEPQ has 5.22 billion, and then Global X has covered calls. So JEPI and JEPQ do 80%, I believe, investing in the index, and then they do 20% in exchange-linked notes, and they write covered calls and do their overlay in the ELN section. It's different than the Global X ones. The Global X's buy the actual all the companies in the index, and then they write calls at the money on those indexes. This is interesting because this is investing in T-bills using it as collateral and doing an options overlay with credit spreads on these indexes. So it's going to be very interesting to see the type of yield that this could generate. And with how big these other products have become, this could be a big generator, because when you think about JP Morgan's charging 0.35%, got 35 billion in assets under management, they're charging 0.33% as a management fee. That's just reoccurring revenue. That's great. I mean, I'm all for this.
So I could buy JEPI, JEPI, correct? If I wanted to right now?
Yeah. Well, you could buy Tuesday morning, but yes.
So what is the benefit of buying this over just buying JP Morgan stock?
Well, it's two different things.
Well, yeah, two different complete things.
Like if you want income, JEPI's paying you a monthly dividend or distribution. It's double-digit yield.
It's a 7.7% 30-day yield.
No, don't look at that.
This is what it says on Robinhood.
Do you
JEPI's paying you
7.7% 30 days every month.
The dividend yield's 10% on a trailing 12.
Okay.
So
wait, so hold on. So I've never heard of these before. So I'm very ignorant to this. So you can
ETFs?
invest. No, but this particular type of ETF that's paying you a monthly dividend.
yes.
So
There's a lot to do it.
Wait, but that's 10% a year, not a month, right?
10% a year, correct.
Okay. So 10% a year. And the benefit of owning this over like SPY is what?
So it's two different things. You're investing in SPY, you're investing for the long term, you're buying the S&P. Low dividend, but you're not buying it for that. You're buying that just to be invested in the market, and as time goes up, you're going to increase your value. JEPI, these people like to call these gimmicky, but they're not. People who call them gimmicky just don't do their homework. They are products geared toward income investors or people who are interested in generating in this case, monthly income. And it's not buying this to match the market. It's buying it to either one, generate income every month they're taking as cash, or two, put a block of money into it, generate the monthly dividends, reinvest them, create additional dividends every month and generate compounding, and then eventually take it as cash.
And so correct me if I'm wrong. The reason I'd invest like in JEPI over a good solid like AT&T or Verizon dividend paying stock is because this is a ETF of it's more safer than just one single bet on a dividend stock, correct?
I mean,
that's even hard to say.
Everything in the market has risk.
Yeah.
One could say that JEPI has less risk than an individual stock because it's buying a basket and it actually owns a basket of the underlying asset. So the top 10 holdings in JEPI right now are Amazon, Adobe, MasterCard, Microsoft, Comcast, Intuit, Accenture, Visa, Eden Corp, and Progressive Corp.
Right.
So 80% of it is the actual assets, and then they run an ELN, which allows them to generate this yield. So
SoFi is going to make something like this, is what you're saying.
They're going to make something like this, and it's good because, as you're aware, options have really come to fruition over the past couple of years. 5-10 years ago, there were not a lot of people in the option market. Now there is, and there's actual products that basically, instead of writing cover calls the way I do, you can just buy QYLD or XYLD, and it basically buys the companies in the S&P or the NASDAQ 100, does a cover call overlay, and generates a double-digit yield. So this is going to be interesting because there are people that want to own products like this to generate the higher yield, and we're going to get management fees on it. It's very smart they're doing this because there is a big segment of people that like this, in addition to closed-end funds that do something similar. Like there are closed-end funds that do similar things as JEPI and QYLD. So there's a big market for it. Very excited to see how SoFi, I can see them advertising this on risk reversal media, stuff that Liz Young does on Dan Nathan and Guy Adami's podcast. I can see it on some of those other things. So it'll be interesting to see what flows into this.
I think they did the post highlight, Stephen, when this is going to be starting. I think it was October. I think they said towards the end of the year.
Yeah, I didn't see that in here, but I didn't read it word for word. I just skimmed through it to get the broad strokes.
Yeah.
So can we be honest?
Am I going to buy it? Most likely.
Yeah, this is like an absolute nothing burger. Like, I can't stress it enough how small the ETFs on SoFi are. Not even a single one of them has $1 billion in assets under management. Most of them, aside from like two of them, like Meet Kevin's funds are larger than all of SoFi's ETFs. I manage more money through my career than most of these ETFs. Like,
it's not about today.
No, I know, but it's probably costing us more money to pump out all of these crappy ETFs that no one wants, rather than just doing what has worked always, which is their SoFi Select 500 ETF. Eventually, you have to start to think about the 80-20 rule and just do the big important products first and stop putting out this crap that they're probably putting more engineers, developers, and asset managers towards that is just losing us money. It's not even a product like worth even covering, in my opinion.
For them to create a wealth management arm and to have a robust product offering that appeals to more investors than just your standard index fund investors, you're going to need a suite of products. This fits a need for income investors, and typically income investors have more money to invest. They've already made their money. They're looking to generate yields. This is a pathway to get more money coming in assets under management.
We have SoFi Weekly Income ETFs, SoFi Weekly Dividend ETFs, for which, both already exist. And then let me just click through to them for how
weekly.
Look at the yield on the weekly, though.
Oh, SoFi Week. I got it.
Yeah.
There you
Look
go.
at the yield on it. This is going to be most likely a high yield product.
Okay, wait. Give me one quick second.
Yeah, but don't they have like 4 or 5 ETFs total, and 80% of them were released this year?
I think 8.
A lot of okay, let's look at this one right here, the weekly one, the weekly dividend, which everyone freaked out about because it was kind of like, oh my gosh, we all thought monthly was exciting. Weekly, SoFi is going to take this to the moon. created
Yeah, it's
back.
got 10 million in management and it has a 3% yield. People aren't getting excited over a 3% yield. I got news for everybody.
10 million
I get it.
in assets under management. It's costing them more to run this thing than for what they're making. ETFs, remember, are like some of the smallest earning portfolios. This is not active management. This is passive management, right? So you're making no money on this. Like they're losing money on this product, and it was created back in 2021.
Once again, you have to look at the bigger picture and the down the road. This is about creating a product that appeals to a certain group of investors and to bring more money in. And eventually they'll have a large product suite. They get bigger, start wealth management. They will be generating expense ratios across those suite of products. This isn't about today or tomorrow. It's about building out that brand and just having more products. Because look, we don't know what the yield's going to be. But if the yield's going to be in the 8 to 12% range because of this options overlay strategy, it's going to become very appealing against these other products, especially since the base is not holding stocks. The base is holding treasuries. So theoretically, there should be less fluctuation than these other funds. So that's what makes this very appealing. So for somebody that wants the high yield, but doesn't want the fluctuation that a QILD or a JEPI has, depending on what the yield is, if this is 8 to 10% or 8 to 12%, and it doesn't really fluctuate that much, you're going to see a lot of people probably consider it as the Fed cuts rates because risk-free assets no longer look as appealing with a 3 or 4% yield than a 5 or 6% yield.
I mean, I don't think a dividend just looking at 3% is fair to say that, because then I think it discounts the idea of the actual, like the actual price of the shares to go up as well. That's kind of not priced into the dividend.
That's not why you would be buying these ETFs. I'm not buying JEPI because I want the price to go up. I'm not buying QILD because I want the price to go up. They're part of
but whenever there is a 3% dividend
income strategy,
then with that idea, then there would be no stock that has less than a 5.5% dividend would ever move, because if people are only considering the dividend, because you just buy T-bills.
Well, but that's also why you're not getting a lot of people excited about Coca-Cola today, because why take single stock risk that can possibly go down when the yield is 3% versus buying a T-bill at 5.5% or 5.25%. You need rates to go down to make stock yields that are in the low single digits more attractive. And as rates come down, these high yield funds are going to look very attractive.
Not to mention the 0.5% expense ratio on top of that, which is going to eat into your earnings, which is really low. I'll give it. I mean, it's not low compared to ETFs, but it is low compared to managed funds for sure.
Yeah, there's managed funds in income that charge a 2% expense ratio.
Yeah, but those are active. Higher. But those are active, right? You're paying an advisor 1% of that. You're paying the fund company 0.5% of that, and you're paying like.
There's one for BDCs, what the hell is the name of it? Anyway, I think it's like, hold on.
What does BDC stand for, Steve?
Business Development Company. Why?
Oh, okay.
That's what does it mean to you, Tevez?
Business Development Company, obviously.
Yeah, Business Development Company.
Regardless, Tanner, you think this is a good thing for SoFi, even if you think it's a nothing burger?
Yeah, I mean, sure, it's fine. Like more products, the more cross-selling, everything like this. I'm happy, but like these very small niche ETFs, I've never understood why people get even remotely excited or to post on Reddit or in Twitter or whatever. It's nothing. It honestly should be looked at as a negative aspect of the company right now, as it's just going to bring in losses.
That's crazy, bro. So. Crazy in the sense of it's so interesting, because last week I thought Instacart was negative for them, even though it's good, and you think this is negative, even though it's probably good, right? Long term.
Do you know how little 10 million in assets under management is?
But that's not JEPI. That's
no, it's not. But that whenever you're in the ETF market, that's a market that is very hard for a fintech company to innovate on. That's a place where JP Morgan can really throw its weight around.
But if SoFi is going to become a very large financial institution, they're going to have to grow out their wealth management. And if they do, they will be able to put backing behind it and get clients interested in it. And once again, There's a reason that these high yield covered call or call option overlay strategy ETFs have a large asset under management. There are a lot of people that are very interested in them.
I keep seeing Jeppy's ticker all over Twitter. Like, it's one of those things where people just cannot stop talking about Jeppy. That and Mullen Automotive. So, I mean,
look, Jeppy has gained a tremendous amount of assets under management since I started following it. And it's because it has the potential. The upside is not capped because they're not writing options on their holdings. Whereas the Global X ones are capping the upside potential and paying you up front is they are capping the gains from writing cover calls on the underlying assets. Jeppy is taking 20% and doing everything through ELNs. So this becomes interesting from an actual income perspective. It's going to take a while to see how this plays out. All I'm saying is that based on what Global X has done and based on what JP Morgan has done with their publicized high income derivative plays, this could really be very interesting. And if this gets to a couple of billion in assets under management, maybe they do another one and eventually it becomes good reoccurring revenue. I agree that if it's 10 or 20 million, it's a dud and it's not really going to be beneficial. But that's remains to be seen about how big it grows.
Well, when they get to $1 billion, let me know, but they're not even there yet. So
right. But Tanner, if it does get to $1 billion, it will probably be beneficial, correct?
I mean, I'm not even sure that's true. Like, I find like whenever you're talking about these, like these net assets, only one of them do I think is a real fund, and that's SFY. And I do think that that's an important product. And then all these other ones is just like, who are you selling these to? And it's no one. They have some that has $1 million in assets under management. There's how many people in the chat have more than that in assets under management in funds, and let alone like, you know what I mean? And by the way, Matt Money, whenever I'm talking about my millions, I'm not talking about my money. I'm talking about client money. I'm a financial advisor. It's actually really easy to get like think about how many clients you need to get 10 million in assets under management. It doesn't take very long.
All right, so we have 6 minutes left. Any last thing? I'm playing a Mitts role here.
We got Pouncer Weekly. Steve, you're on tonight. Okay.
I don't know if I can make it, man.
No, wait, well, you're on. You got to be on. We got Morgan Stanley. These guys fucked us this week. We got to talk about it. All right, Tevis, go ahead.
So let's go over the Robinhood thing for a minute.
Let's go over the hood.
What is it? What happened? Oh, they're buying back stuff? Is that it?
That matters.
They're buying back Sam Bankman-Fried's shares that he had bought back in May of 2022, which is good. I think he bought around this price anyway, or maybe a little bit less. Maybe he made a profit on $8, something like that. And then they bought it all back for about $606 million, and the stock ran up 2%, even though they bought out 7% of the outstanding share base. Meaning
it was up 4% at one point, but
yeah, but the investors don't like that. They didn't like the
no. You're wrong on this, Tanner. Investors hated that there was 55 million shares that theoretically could have been dumped on the market and would have flooded and diluted them. But so I think a lot of institutional investors were waiting for this. It's been a year since this deal finally happened.
Yeah, no, it seems like they loved it. The stock's up 2% on a 7% forced purchase.
Yeah, but the stock's also up, I think, like 10% in the past week or 2 weeks after hitting. So, I mean, I get what you're saying, but it's important that we got this part resolved. Look, I agree with you. His Tanner's FinTech Frenzy today was basically like, if the August numbers for Robinhood suck in terms of monthly actives and all that stuff, then they're in a bad spot. I disagree in the sense of I don't think August numbers mean everything, because I don't think August was the best month in the world. But I do think that if we see, and we saw a lot of inflation data, we didn't talk about that, it was on the right side. If that leads to the Fed pausing over the next couple of months, we should see those MAUs go up. If it doesn't, you're correct, Tanner. But I think we have to really see a bull market for that to happen.
The problem is I find that June and July were those very amazing months, and the numbers didn't improve.
But I think a lot of investors were hesitant those 2 months because it was the first 2 amazing months after a year and a half, you know?
Yeah.
So the way I'm looking at Robinhood is it's interesting, and I'm considering, haven't made up my mind yet, starting a position for certain reasons. They got $5.8 billion in cash.
5.2.
So I'm looking at the balance sheet. 5.
Yeah, well, they just bought $600 million worth of their own shares today.
Okay.
So
5.2, fine. Got over $5 billion in cash on hand. Total debt is $3.1 billion. So they have more cash on hand than debt. And they are now GAAP profitable. I want to see if it stays GAAP profitable. I may not start a position yet. I may wait for one more quarter of data to see if they're GAAP profitable again. But this is a company that, for some reason, people seem to love, people seem to use it, and it could be a good acquisition target. I mean, you got $7.18 billion in total equity on the balance sheet, and the market cap right now is $9.9 billion. You're not paying that much of a premium on the company's equity. And if they keep increasing revenue, and if they continue to be GAAP profitable, what's the underlying tech worth? What's the book worth? I mean, look, TD Ameritrade got bought out for a healthy premium. E-Trade got bought out for a healthy premium.
yeah,
It's not far-fetched to say that Robinhood of all companies can't fetch a solid premium on an acquisition. And I would like to think that there are a bunch of companies that would benefit from adding that book of business in. And if rates start to come down next year, and if we do go into a bull market the way I think we're going to, regardless of what the next couple of months are, even if their net interest income declines, they should make money from trading, which should offset it. So it's interesting. I don't think it's a dog of a stock right now. I think it was super overvalued previously, and it's come down to reality where now I think you can make a bull case for it because the fundamentals kind of make sense. I don't see much downside from here is basically my premise.
yeah.
And I'm trying to figure out what the upside is and if it's worth buying some shares and just selling some calls against them at a little bit out of the money. And if they get called away, great, made a profit and made some immediate income.
I do actually think you're right. I don't know what the how much downside there actually is, just because of the large cash base that actually they hold. So I think that's fine. It's mainly just the upside. I just feel like everyone that I talk to tells me that this is by far the best platform, aside from you, Stephen. You'll say Thinkorswim, but that this is the best platform to invest on. People like I really respect tell me this is the platform to be on. Okay,
I am shocked that TJ uses it. Okay. And when I was on TJ's podcast and he was using it live with me on it, I was really shocked at how easy and intuitive it is. And I will say the options part looked very well done.
Yeah.
I think the overall product is not for me, but obviously a lot of people like it and they're not gravitating away from it. And there aren't many options out there. I mean, yeah, we like to say there are, but in reality, there aren't many options for platforms. I mean, you can count them probably on two hands. So,
before we wrap up, Tanner, like, I don't understand what you mean by the upside is the like, if you're buying into the thesis that they're an acquisition target, like the upside is pretty healthy. I mean, it's if you're thinking that, okay, well, they're 10 billion and their float is decreasing and they're going to get a healthy premium, whatever, let's say 15, maybe higher than that. Sure. And they're going to get bought out. Well, hell, like that's pretty much like why we're investing in PayPal, for not the buyout, but for, a 50, 80, maybe a percent, maybe a 2x, 100%. Like,
yeah, but I don't think the valuation is nearly as cheap.
But also like this,
like the ups, you can't be like, okay, well, it doesn't have upside because it's whatever, a potential 100% return.
Schwab bought Ameritrade, Morgan Stanley bought E-Trade. We've already seen consolidation in the past year. We could see more, and it would make sense that the fintech companies are going to need to consolidate to gain ground and create a wider moat. Ally Financial, it would be an interesting company to acquire. Robinhood. Ally
Yeah.
has a good amount of cash on hand. They're a strong company, strong bank. Robinhood would fit right in. That's a bolt-on acquisition. I mean, I don't know. There's companies that would benefit from synergy, even if it's a merger, not an acquisition.
I was going to say probably more of a merger, right?
Yeah, it's interesting. I mean, I'm not completely sold yet, but I don't think it's a dumb idea by any means, and I don't see a lot of downside from here. Like, yeah, sure, it could go down, but I think it's backstopped with the amount of cash they have.
Did you take a look at their stock-based compensation? Like while we're waiting for the stock to go up, did you see how much they're diluting?
I did. I don't remember. I'm pulling it up right now. Hold on.
Yeah.
All right, that's the last thing. Then we gotta end.
Yeah, I mean, the stock-based comp is down from 2021, but it's still high, and that's also something that I would
down
like
from
to
being
see.
46% of revenue down to 22 is quite
No,
the.
I get it, but at the same time, if they're able to be GAAP profitable with the stock-based compensation, I've said about other companies, I'll say it about them. If they're going to grow profits, I don't have problem with them paying their employees through stock-based comp, because then their employees have more skin in the game. It's when companies are losing money and they're diluting through stock-based compensation that I have a problem with it. So if they can keep the GAAP profitability going and growing in addition to revenue, I don't have nearly as much as a problem with stock-based compensation. So that's why I need another quarter of data before I even think about putting money in. But it's interesting. It's very interesting at the moment.
Yeah, perfect. All right.
So Tanner, I want to show you something before we go.
Okay. Steve, we gotta go. We got another podcast.
So we are going to start Alternative Asset Weekly, and I made another purchase.
Oh, you texted me this.
9.8. I don't even know what that is, but that's a perfect Spider-Man comic right there.
Autographed by the legendary Todd McFarlane.
How much did you pay for that?
So it wasn't that expensive. I am up on it from when I bought it, but the reason I bought it is because Todd McFarlane is one of the legendary artists. He broke off from Marvel, started Image Comics with a couple of other artists and writers from Marvel, and he did Spider-Man 300 and a bunch of other issues, and then started his own Spider-Man series, and this was the first one in the series that he started. So I want an autographed version of it. So I purchased that. I am planning on making some other purchases from some things I've been researching. But yes, Alternative Investment Weekly is coming at some point. And I'm going to get you guys into it.
I didn't hear how much you paid for it.
So not a lot. I paid $265.
5 figures? 4 figures?
No. I got so it sold the other day for $360. Yeah, $360 it sold for the other
ETF
day.
says looks fake to me.
I paid $265 for it, but what I do is I look for auctions that
wait, $265, that's it?
Yeah.
So I'll buy one too, man.
It's not a lot.
That feels like nothing for an autographed.
Yeah, and the worst part about it is he says he's up on the investment, and the problem with alternative assets is you need a buyer to be up on your investment. The liquidity on those products are so low.
The last one that sold had over 40 bids on it. These are liquid. You can sell them at any point.
All right.
And that's one of the things. You got to look at how many sell, how many bids are on them, and how frequently they sell. Now, also their population reports for how many percentages are 9.8s, 9.6s, et cetera, et cetera. But this is a huge market that if you look at bids that end during the week at obscure times when people are sleeping, you can get stuff under market value because most people.
Steve's waking up at 4 a.m. to buy these things.
Maybe.
Just outbidding some kid in Asia.
I may set an alarm in the middle of the night and get up and check my auctions and my stuff I'm bidding on. Yes.
All right, Steve, we got to go. We got to end this.
Last question. With that comic book, can you ever like flip through it and just read it? Or do you have to?
No, they're closed.
No,
you can't open this shit.
Once it's graded, you can't touch it.
Yeah, it's graded. It's sealed by CGC, but you can buy a regular version and flip through it if you want.
All right.
All right. That's it, everybody. Hope you enjoyed. See you next week. And if you're interested in Palantir, we're starting Palantir Weekly.
Thank
you, everybody. Have a good one. Bye-bye.
But yes, Tanner.